We all know that there are different types of patterns when it comes to price action, but on today's video we are going to look for continuation patterns and also how to master it as a pro trader. We are going to focus on 4 patterns, which is bull flag pattern, which is bear flag pattern, which is an expanding triangle pattern, which is symmetrical triangle pattern. If you want to know more about them and also how to trade them like a pro, make sure that you stay tuned. Let's jump on my screen. All right, let me show you what is a bull flag pattern and also explain what is it in deeper details before we go to the actual market and show you that it is working. Now let's say that we are in an uptrend. We are having something like this. We are in an uptrend. Now the market starts to have a continuation pattern on a downside like this, and then starts to shoot up. This is what we call a bull bear. This is what we call a bull flag pattern. So what you're going to do, you're going to draw your trend line like this. You're going to have your trend line like this, and then also have a trend line on the downside of the market to show that this is a bull flag. As you can see, this is a bull flag. The market went up and start to reverse and then goes up. And also we have 2 entries, but then I'm going to explain them later. So a bull flag resembles a flag pole. This is a pole right over here. This is a pole. It resembles a flag pole because it is in an impulse bullish price movement. Like I said, we are in a bullish price movement. Price will impulse up, like over right here. Price will impulse up and form a sideways flag. This is our sideways flag continuation that signals to us price is ready to continue its impulsive move nature on the breakout of the flag. This is our breakout of the flag where you're going to enter your trade, but then you can also enter your trade right over here. Let's go to the actual market and show you guys what I'm talking about. Here we are at the actual market. Like I said, we are looking for a bull flag pattern. So meaning that we are looking for the market that is trending on the upper side. Okay, so as you can see here, we are going on the upper side of the market, and here right over here we have our sideways flag where it was forming. So what you're going to do is to take your trend line, take your higher high right over here, and then put it right over here like this. This is what you are going to have. And also you need to clone this to make it be more appropriate. Some people don't clone it, that is why it's not appropriate. You need to clone it to have the very same thing on the downside. This is what you have. As you can see, this is the flag that we are talking about. We have a movement to the upper side, and then we have a sideways to the sound today. We have a move to the upper side, which is an impulse move, and then we have a sideways to the downside in a correction manner, and then we have an impulse move to the upper side. There are 2 entries when we look at this. We have an entry right over here at the breakout, and then we have a risk entry. This one is called a risk entry. That's where you're going to enter your trades at your own risk. It says a risk entry because you don't have a confluent, a proper entry or signal to say now you can enter, but because of you trust your bull flag pattern, you're going to enter over here. On number 2, we have a bear flag. A bear flag is when the market comes from the top, go to the bottom, just like that. It's going to form a flag, something like this, and then shoot to the downside. This is what we call a bear flag. And then you are going to have your own trend line. To confirm that it's a flag, you need to put your trend line on the continuation form where the market starts to consolidate before it gives us the bear movement of the market. The bear flag, it resembles an inverted flag as price has just impulsed to the downside. Like I said, formed a tight continuation pattern resembling a flag, allowing us to focus the next impulsive leg to hit the downside. So if you see that the market, it kept on going down, and now that the move is no longer impulsive, it start to consolidate in a way of taking the opposite direction of the market, just know that it preparing itself to shoot to the downside. So let's go to the actual market and show you how to trade this and take sniper entries or risk entries on an actual market. Let me see. Yeah, on an actual market, as you can see that the market came and gave us an impulse move to the downside, and also gave us a correction right over here, and also shot to the downside. It kept going to the downside, but we're going to focus right over here. As you can see, this is our impulse movement, this is our correction, and then this is our impulse movement to the downside. Now we are going to have our trend line on our lower low, and then pointed straight to our lower lows until to the break of the structure. And also we're going to do the very same thing on the upper side, which we are going to have something like this. Right over here, we call it a fake out. If you want me to make a video about a fake out, make sure that you comment down below and let me know, so I can maybe make a video whereby I'm going to show you how to spot the fake out, not to be on the wrong side of the market thinking that it broke the trend line. It didn't broke the trend line. It was trapping some people who don't know how to fake the wrong impression of the market. So if you have something like this, your entry needs to be here, which is the risk entry, and then the late entry needs to be here, which is the late entry, as we said. So this is how you can trade your trend line continuation, which is a bear flag. Now we are going to look for a flat flag. A flat flag is whereby when the market comes from the downside to the upper side like this, we are going to have a consolidation again. The flags are always consolidating to give us the proper movement. So we are going to have a flat consolidation like this one, and then push to the upper side. As you can see, where the market consolidating, it didn't consolidate to go to the upper side, or it didn't consolidate in the direction of going to the downside. It consolidating straight flat. That's why they call it a flat flag, because it doesn't show any direction. But we all know that if you see something like that, we're going to experience a bullish movement after the continuation. So what you're going to do is to have your own trend line like this again. You are having your own trend line like this to confirm that it is a flat flag, and then your entries are going to be right over here or right over here. Let's go to the actual market and show you what I'm really talking about. As you can see right over here, the market comes on the upper side, right? Flat flag actually works on a bullish trend and also on a bearish trend. So this is a bearish trend, as you can see, but I made the example based on the bullish trend line, but it's still the very same thing because it is flat. So now that we are having a downside of the market, if you can see right over here is a consolidation. The market doesn't show any direction, doesn't consolidate to show us, it doesn't consolidate like this from here, it doesn't consolidate like this, it doesn't show something like that, right? So what it does right over here, it shows us something like this. It shows us something like this, which is a flat flag, right? So when we see something like this, our trend lines are going to be right over here. This is how we're going to have our own trend line, because it is flat, it doesn't show us any direction. But some people, what they do, they don't draw their trend lines, but they draw their triangle to represent support and resistance, which is fair enough. They're going to draw something like this, which is fair enough to show that this thing doesn't have a direction. It consolidating right inside over here, and when it's break, that's when you enter into the market. Or when it hit your resistance, that's when you enter market, meaning that you're going to have an entry, a risk entry right over here. But before you wait for your own confirmation, if you want me to make a video whereby I explain the candlestick confirmation that you need to look at when you see something like this, make sure that you comment down below, and also I will make a video based on them. So this is what we're going to, it's a simple 1:5 risk ratio. It's a very good trade to take. Now let's look at symmetrical triangle pattern. This pattern also works on bearish trend, but then we are now focusing on bullish. If you want to see a video whereby I explain the bearish patterns, please make sure that you comment down below. So when we have a symmetrical triangle, we check whether the market comes from the upper side or downside. Since we have more focus on the upper side, we are now going to look at it when it comes from the downside. So now we have something like this. The market comes and then does something like this, comes, does something like this. It starts to squeeze itself before it can give us the right move. What you're going to do is to come and draw your trend lines to support that you are having a symmetrical trend line, that you are having something like this. So when we see something like this, a pattern like this, just know that your entry needs to be right over here or after the breakout. But it is always safe to trade it when it breaks out of the trend line. Let's go to the actual market and show you how exactly to trade this pattern. Now, as you can see right over here, let's focus right over here. The market comes, right? It was doing the higher highs and higher lows, right? And then it comes to do the lower lows and lower highs, right? So now, if you can check right over here, we have our impulse move to the downside. And then the market starts to make our symmetrical triangle to squeeze itself. To see that it actually formed a symmetrical triangle, you need to come and draw your trend lines like this. This is what you are going to do to confirm that it's a symmetrical triangle. So your entry point, like I said, your entry point needs to be at the breakout to be on the safer side. This is what you're going to trade, and also your stop loss needs to be below right there. Your take profit on this, usually it rides over here, but then you can still go down with it. Imagine if you took this trade, you are about to have a 1:3 risk ratio, which is very good. Now the last pattern we are looking at is expanding triangle. Expanding triangle bullish is whereby we're seeing something like this. The market comes from the downside to the upper side. It forms something like this, comes to the upper side, and it starts to do something like this. It starts to expanding. That's why they say when it's correlate and then give us a move to the upper side. So you are going to take your trend line and put it like this to confirm that it is expanding, and also do the very same thing on the downside. This is what we call an expanding triangle. It's another form of continuation that is easily distinguishable from the other form of patterns that we covered. It is a pattern that is less common, but when it plays out, can offer up big risk to reward. So as you can see that it always have a big risk to reward because of its expandation. If you can see that if you enter your trades right over here, and also your stop loss is going to be right over here, look at the risk to reward that you're going to have. You're going to have 1:5. Imagine if it breaks above, you're also going to have more than that. That's why they are saying when it's placed, it's going to offer up to big risk to reward. The triangle expands outside, but is still a continuation pattern. Now let's go to the actual market and show you how to exactly spot it and trade it. As we can see, the market comes from the downside, goes to the upper side. So what we're going to check is whether the market really does expanding. If you can check right over here, we are checking our higher highs and our higher lows. So now we're going to take our trend lines to our higher highs only. If you can check, we are going to have something like this up until right over there. But when we go to the downside, we are having a very same thing correlation. If you can check right over here, we are having a flag, but we are having a reversal flag. I'm still going to make a video based on it. But if you can check, when it comes to right over here, the market starts to go to form a lower lows, lower lows, lower lows. But when you check on the upper side, it doesn't form a lower highs, lower highs, lower. It's still forming a higher highs, meaning that where you start to see that the market forms our lower lows, that's where you're going to point your trend lines like this. This is what you're going to have. This part right over here, it's called expanding triangle. So this is our first touch, this is our second touch, this is our third touch. Where you're going to enter your trade. Remember, we said that it doesn't place out more often, but when it does, it always gives you a big risk to reward. So let's check if maybe you got this trade. How many risk to reward are you going to have to accumulate on this trade? Remember that you are going to take this trade and then put your stop loss right over there. Remember, before you take this trade right over here, you need to have a confirmation of a candlestick. I'm still going to make a video, comment down below if you need it. I'm still going to make a video where I explain the candlestick that you need to be aware, that need to be represented before you take this trade. So let's see how many risk to reward were you going to have throughout this trade. You are going to experience 1:17 risk to ratio, meaning that even if you can lose 10 trades, you still have up 7% of your trades.